Hello, everyone. My name is Yaman, and I provide daily updates on Tesla, markets, and technology. Let's get started. It's a slow day today. We're going to take our time a little bit. Not much news, but there's a few. So let me go here. You can see the oil market is open today. The oil market is drifting upwards after the initial news of escalating geopolitical concerns in the Middle East. You can see in June 13, prices surged, but then they came back down a little bit and now they're going back up again. So now oil price is $76 per barrel. We have mentioned this before a number of times. And I think it's going to be a big problem for inflation story. For the disinflation story, I think this is a big headwind. So you can see June started at $60 per barrel, and it went up as high as 78, and now it's around 76. And if I remember correctly, every $10 per barrel increase in oil prices means 0.3, 0.4 increase in the headline inflation. So this is not good. Let's move on to stocks tumble, dollar up as Middle East war lights safe haven trade. Global stocks fell and dollar rose on Thursday, reflecting investors' performance for perceived safe havens as concerns mounted over possible U.S. involvement in the Israel-Iran air war, which has ignited a rally in the oil price this week. Any questions, comments, please leave it in the chat. On the geopolitical front, President Donald Trump kept the world guessing about whether the U.S. would join Israel's bombardment of Iranian nuclear sites, telling reporters outside the White House on Thursday, "I may do it, I may not do it." A flurry of central bank decisions in Europe highlighted how Trump's erratic approach to trade and tariffs has complicated the job of central bankers in setting monetary policy. In Europe, stocks fell for a third day, leaving their index down nearly 2.5% on the week, set for its biggest week-on-week decline since the tariff-induced turmoil in April. U.S. futures fell 0.5%, although most U.S. markets were closed for a public holiday. Speculation was rife that U.S. will intervene, something that would mark a material escalation and could invite direct retaliation against the U.S. by Iran. Such a scenario would raise the risk of a greater regional conflict with implications for global energy supply and probably economic growth. Much of the recent nervousness in markets has been centered around crude supply shocks from the Middle East, which has driven the price of crude oil by 11% in a week. Brent crude rose as much as nearly 1% to $77.40 a barrel, close to its highest since January. Gold is up at 3,372. Dollar itself rose broadly, leaving the euro down 0.1 at 1.1466. Overnight, the Federal Reserve delivered mixed signals to markets. I don't think it was that mixed, honestly. I watched it. Much to Trump's displeasure, policymakers held rates steady as expected and retained projections for 2-quarter-point rate cuts this year. However, Fed Chair Jerome Powell struck a cautious note about further easing ahead, saying at his press conference that he expects meaningful inflation ahead as a result of Trump's aggressive trade tariffs. Strategists at MUFG said the Fed is underestimating the weakness in the economy that was present before the tariff shock, specifically almost ignoring the cracks that have been visible in the labor markets for years. The Bank of England left UK rates unchanged, as expected, and the policymakers said trade policy uncertainty would continue to hurt the economy, triggering a drop in the pound. The Norges Bank surprised markets with a quarter-point cut that weighed down the crown currency, while the Swiss National Bank cut interest rates to zero, as expected. But the fact it did not go below zero gave the franc a lift, leaving the dollar down 0.1%. The commodity markets, the price of platinum hit its highest in almost 11 years, near $1,300 an ounce, driven partly by analysts said what was consumers seeking a cheaper alternative to gold. Interesting. Let's look into the geopolitical concerns a little bit more. Satellite images show Iran racing to get its oil out. Iran is racing to get its oil out into the world, a sign of the unusual logistical steps that Tehran is undertaking as the U.S. mulls joining Israel in bombing the Persian Gulf state. This could really shape the markets in the coming weeks and months, so I want to understand geopolitical dynamics a little bit more. Oil is gushing out of the nation's ports and onto ocean tankers, ensuring revenues would continue, at least for a while, if shipments are disrupted. Despite the surge, storage tanks at the nation's critical export terminal are brimming with crude. Traders and investors are parsing every piece of data available to understand how oil from the Islamic Republic and the wider Gulf region will be affected as Israel pounds the country's nuclear sites, military, and wider energy infrastructure. Satellite data offer at least part of the answer when it comes to Iran. The oil storage sites at Kharn Island have floating roofs that rise and fall as they empty and fill, meaning it's possible to get clues from above as to just how much they are holding by examining their shadows. And what images from June 11 show is that for almost all of the large tanks, the roofs were well below the tops of the walls. In short, the reservoirs were only partially full. Fast forward by a week, and a photo from June 18, several days after Israel began its attacks, shows there are no such shadows, indicating that the roofs are now at the top of the walls and the reservoirs are brimming. There are still shadows cast by the tanks on the ground beside them, confirming that the absence isn't due to a lack of sunshine. The images were taken less than 10 minutes apart at about 2:40 p.m. local time on their respective days with nearly the same sensor geometry. Samir Madani, co-founder of tankertrackers.com, a firm that specializes in monitoring the clandestine oil trade of Iran and other nations using satellite imagery, confirmed that he also saw a rise in crude inventories at the island. That's not what you would expect, given that Iran has been driving up its exports. If the exports are well above normal, then storage tanks should be emptying, unless Iran is also directing even more crude into the facility. The inference then is that Iran is sending as much as possible to the global market while it can. Iran can store about 28 million barrels of crude at KARG, according to a 2024 report from S&P Global Commodity Insights. I think the world consumes about 100 million barrels a day, but 28 million is a lot, actually. Refurbishment of two 1 million barrel tanks was completed last month, but it's unclear whether they were included in the earlier capacity figure. All right. Let's dig into the stock market a little bit more. Dow posts narrowed loss after Fed signals it's in no hurry to cut rates. This is from CNBC, which I think they have a pretty good coverage of the Fed action. So the Dow Jones Industrial Average fell modestly following the Federal Reserve decision to keep interest rates steady. The Fed signaled 2 rate cuts this year, but also hinted at the stagflationary threats, lowering the 2025 economic growth forecast and raising the core inflation outlook. Stocks were also impacted by the ongoing conflict between Israel and Iran, which raised oil prices. The Fed left its key rate unchanged. Let's look into that a little bit more. Fed holds key rate steady, still sees 2 more rate cuts this year. The Federal Reserve on Wednesday kept interest rates steady amid expectations of higher inflation and lower economic growth ahead, and still pointed to 2 reductions later this year. With markets expecting no chance of a central bank move this week, the Fed kept its borrowing rate range between 4.25% and 4.5%, where it has been since December. Along with the rate decision, the committee indicated through its closely watched dot plot that 2 cuts by the end of 2025 are still on the table. However, it lopped off 1 reduction for both 2026 and 2027. So basically, higher for longer, putting the expected future rate cuts at 4 or a full percentage point. The plot indicated continued uncertainty from Fed officials about the future of rates. Each dot represents one official's expectations for rates. There was a wide dispersion on the matrix, with an outlook pointing to a Fed funds rate around 3.4% in 2027. 7 of the 19 participants indicated they wanted no cuts this year, up from 4 in March. However, the committee approved the policy statement unanimously. Interesting. 7 out of the 19 participants indicated they wanted no cuts this year. Wow. Economic projections from meeting participants pointed to further stagflationary pressures, with participants seeing the gross domestic product advancing at a 1.4% pace in 2025, inflation hitting 3%. So inflation is going to hit 3%. I think this is pretty much a foregone conclusion as these tariffs kick in into the data. There's a lot of rhetoric out there from people who would benefit from lower rates, whether they're holding stocks or whether they're politicians on the Republican administration side, that the inflation is low inflation is at target, or I saw somebody claim that it's actually below target. These are all false rhetorics. Inflation is still high, 2.5% to 3%, and it might actually go up from here to further, depending on how high the oil prices go, depending on how the tariff situation pans out. But it's going to recover above 3. It's just a matter of how much higher it's going to go up. GDP forecast comes down. The revised forecast from the last update in March represented a decrease of 0.3 percentage point for GDP and an increase of the same amount for the Personal Consumption Expenditures Price Index. Core PCE, which eliminates food and energy prices, was projected at 3.1%, also 0.3 percentage point higher. There you go. So the Fed is increasing inflation forecast. You have to. Tariffs are kicking in. You have to increase your forecast from your base case. And at the same time, lowering GDP. So basically, the Fed is saying tariffs are stagflationary. The unemployment outlook saw a small revision up to 4.5% or 0.1% percentage point higher than March and 0.3 percentage point above the current level. The FOMC statement changed little from the May meeting. Broadly speaking, the economy grew at a solid pace with low unemployment and somewhat elevated inflation, the committee said. Moreover, the committee indicated that less concern about the gyrations of the economy and clouds over the White House trade policy. Uncertainty about economic outlook has diminished, but remains elevated. The committee is attentive to the risks to both sides of the dual mandate, the committee said. During a news conference, the Fed Chair Jerome Powell suggested there is time to wait for more clarity. For the time being, we're well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policies. So that means in the next meeting, they're also not going to cut. So no cuts in July meeting. Maybe September, we'll talk. US stocks were wavering near a flat line in the wake of the announcement. Trump pushes for rate cuts. While the Fed statement did not elaborate on why uncertainty has ebbed, President Trump has eased some of its fiery trade rhetoric, and the White House is in the midst of a 90-day negotiating period over tariffs. Trump's rhetoric toward the Fed, however, has not softened. Earlier Wednesday, the president again slammed Powell and his colleagues for not easing. Trump said the Fed funds rate should be at least 2 percentage points lower and derided Powell as stupid for not pushing the committee to cut. Fed officials have been reluctant to move, fearful that tariffs Trump implemented this year could cause inflation in the coming months. I mean, it's actually pretty amazing how the Fed is so uniform in saying we're not going to cut. And this is not just the Powell, also the governors, the regional Fed bank presidents, as well as ex-members of the Federal Reserve are all saying this is not the time to cut. And on the other hand, you have just as passionate Trump saying they should be cutting by 2 percentage points, which is incredible. Fed officials have been reluctant to move, fearful that tariffs will cause inflation in the coming months. Price gauges so far have not indicated that the duties are having much of an impact. A delay in the feed-through of the tariffs, along with softening consumer demand and the build-up of inventories ahead of the April 2 Liberation Day announcement, have helped deflect their impact. Everyone that I know is forecasting a meaningful increase in inflation in the coming months from tariffs because someone has to pay for the tariffs, Powell said. The conflict between Israel and Iran adds another wild card to the policy mix, with prospects of higher energy prices a potential additional factor in keeping the Fed from cutting. He actually didn't talk about the oil price and gasoline prices that much at all. So he didn't really talk about geopolitical risk. So that may not be in the forecast, but it is. We know oil prices are surging in the last couple of weeks, so it's going to get into the forecast at some point. The statement did not mention influence from the Middle East fighting. A gradually softening economy would provide incentive to cut later this year. Recent labor market data shows layoffs creeping higher, long-term unemployment also rising, and consumers spending less. Retail sales tumbled nearly 1% in May, and recent data has reflected a cooling housing market, which starts hitting their lowest level in 5 years. Effectively, they are sitting on their hands, waiting to see if tariffs increase inflation or the job market starts to falter, and whichever part of the dual mandate is impacted first will likely guide whichever direction they take, although the bias is still toward cutting rates, or at least keeping rates unchanged, not raising rates, said Chris Zaccarelli, Chief Investment Officer at Northlight Asset Management. Zaccarelli wasn't surprised that rates held steady. However, he said the market was surprised by the comment that uncertainty had diminished. For Trump, though, the importance of lower rates stems from the high cost of the government paying to finance its $36 trillion debt. Interest on the debt is on track to total $1.2 trillion this year and exceeds all other budget items except Social Security and Medicare. The Fed last cut in December, and Treasury yields have held higher throughout the year, putting additional pressure on a budget deficit likely to approach $2 trillion or more than 6% of GDP. All right, that's all I have on macro. We're switching to Tesla. If you get a chance, please hit the like button and share this with your followers as the live stream goes on, trying to build back this channel, and hopefully you can help me out with it. Threats to Tesla's revenue are piling up. Interesting image. Tesla faces fresh risks to big income stream, sales of regulatory credits to other automakers under vehicle emissions and efficiency rules. Why it matters. Tesla's credit sales were $595 million last quarter and totaled $3.36 billion in the 5 quarters through Q1 of 2025. The credits are awarded to companies like Tesla that exceed emission standards. Producers of gas-powered vehicles buy them to help meet various CO2 and mileage standards. Republicans on the Senate Committee late last week, Commerce Committee late last week, proposed ending civil penalties under the Transportation Department's fuel economy rules. It's part of the committee's portion of the budget reconciliation bill, the top GOP and White House legislative priority. The provision would modestly cut auto prices by ending penalties on automakers that now design cars to conform to the wishes of DC bureaucrats rather than consumers, a GOP summary states. The Senate action would effectively end the market for CAFE credits. Chris Harto, a senior policy analyst at Consumer Reports, tells Axios via email. Dan Becker, who heads the Safe Climate Transport campaign at the Center for Biological Diversity, noted, why buy credits if Trump gives you a get out of CAFE free card? Driving the news separately, DOT on Friday issued an interpretive rule that bars consideration of EVs when it sets these mileage rules. It's a step toward crafting replacement standards, DOT said. This paves the way for less aggressive requirements and less need for buying credits. Several buckets of credits benefit Tesla, the dominant US EV seller. I don't know how dominant they are. EPA emission standards, Transportation Department fuel economy mandates, and California's ambitious clean car program all provide opportunities. European emissions rules also generate credits. The big picture is that regulatory credit market has already facing risk before all the news last week. EPA is now planning to resign Biden-era EPA carbon emission rules for model years 2027 and onward. The House passed a reconciliation bill, and the Senate GOP proposal will also nix them, and the House bill pulls back Biden-era DOT mileage rules. Both chambers have passed measures that end EPA's approval of California's auto emissions rules. Potential loss of credit revenue comes at a perilous time for Tesla. Its sales have slumped in recent quarters, and CEO Elon Musk's rightward turn and the alliance with Trump are among the reasons why. House plans to end $7,500 consumer purchase subsidies for EVs under the Democrats' 2022 Inflation Reduction Act. Credit revenues exceeded Tesla's overall profit last quarter. In other words, it would have been in the red without them. Yes, Q1 was atypical week for Tesla. But consider Q4 of 2024, when Tesla reported $2.1 billion in profits that were helped along by $692 million in credit sales. In Q3, those numbers were $2.17 billion and $739 million, respectively. More broadly, the meltdown of Tesla CEO Elon Musk's relationship with Trump also creates new and unpredictable risks. There are plenty of court battles ahead for Trump 2.0 and GOP policies, including efforts to scuttle California's rules. The bottom line is, if the administration gets its way on all of its stated policy objectives around vehicle regulations, there will no longer be any market in the US for Tesla's regulatory credits, said Harto. All right. Tesla is not having problems on the regulatory credit front, but also on the robotaxi launch as well. This is an electric article by Fred Lambert. Tesla is asked to delay robotaxi launch in Austin by Texas lawmakers. The summary of the article is Texas lawmakers have requested Tesla delay its planned robotaxi launch in Austin until September 1st, 2025, when a new law regarding autonomous driving takes effect. The new law introduces requirements for following federal guidelines and referencing SAE autonomous driving levels. This delay provides Tesla with an opportunity to address concerns about its readiness and compliance with regulations. Let me see if there's any details that I can share with you here. Some background. A group of 7 Austin-based lawmakers in the Texas Senate and House have given a letter asking Tesla to delay its launch until September. As members of the Austin delegation in the Texas Senate and Texas House of Representatives, we are formally requesting that Tesla delay autonomous robotaxi operations until the new law takes effect on September 1, 2025. We believe this is in the best interest for both public safety and building trust in Tesla's operations. If Tesla opts to proceed with the June 22 launch date, we request that you respond to this letter with detailed information demonstrating that Tesla will be compliant with the new law upon the launch of driverless operations in Austin. Texas has had very few regulations, Fred says, affecting autonomous driving. Also introduced requirements for following federal guidelines, and the latest version of the bill references SAE autonomous driving levels. Here's a full letter. All right. Okay. So that's that. That's kind of throws a wrinkle in Tesla's plans for a robotaxi launch. We'll see what they do. But in any case, my expectation has been that Tesla will roll out very slowly, much slower than people realize. And I think it's going to take many years for Tesla robotaxi business to become nationwide adopted. And I estimate 5 to 10 years. If there's an algorithmic breakthrough that I don't know about for now, such as transformers, that may be closer to 5 years. If there isn't, and it's just about buying more GPUs and doing the same old thing, it's going to take 10 years or more to get robotaxi reliability to 9.99%, sorry, 99.9999%, so 6 nines. Currently, it's at 97%, according to TeslaFSDTracker.com, which I believe is a great source. I know there's a lot of misinformation and disinformation campaigns about TeslaFSDTracker.com. I realize I read all of the arguments, but I still believe TeslaFSDTracker.com is the best source out there for FSD data. The website has hundreds of testers, thousands of entries on each version, and tens of thousands of miles of data. So in my mind, that's close to being significant, scientifically significant enough. And I wouldn't dig into the data too much, because the more you dig in, like for example, if you just look at Texas data or New York data, the number of entries become too small to reach any conclusions. But overall, nationwide level of data that TeslaFSDTracker.com has is, in my mind, directionally correct. So V13 is about 97 to 98% reliable. Every 2% of the drives, it makes a critical error, which means way too many deaths. There's no way Tesla would be able to launch that. So I think what they're going to do instead is come up with like a 1 or 2 bus routes, like a fixed route, and make sure they have everything about that route mapped out, and kind of run loops around it like a bus route. And obviously that's not going to be anything more than a demo. It's not going to generate any revenue. It's not going to generate any profits. It's going to be much more limited than Waymo, which has LiDAR, but it's at that reliability level necessary to spread into a wide area of a city, to multiple cities. We discussed yesterday that Waymo is going to be going into New York, starting with supervised drives, but then a few months later, unsupervised drives. A few months after that, wider and wider areas of New York. So in my mind, Tesla is years away from that. So, we'll see how it pans out, but that's my expectation. All right, let's talk about Amazon. There's some interesting stuff going on Amazon that I don't think people are talking about. And this is very important for NVIDIA as well. Okay. This is a December 2024 article, but I think it's very, very important. Amazon announces Project Rainier, an ultra cluster AI supercomputer. Amazon is developing an AI supercomputer, Project Rainier, powered by its Trainium chips. So this is Amazon's in-house design and built Trainium chips. The supercomputer aimed at supporting Anthropic, Amazon made an investment in Anthropic, AI projects. So basically, they built in-house training chips like Tesla was trying to do with Dojo. Amazon did it. And now they're also using it for one of the leading companies' AI projects. Seeks to reduce AI training costs and provide an alternative to NVIDIA GPUs. Now, the news is, I don't think that's in this article, but I saw an interview recently. The news is that Amazon may open their chips, internally developed chips, to other, may sell it to other customers. So Google, for example, just does TPUs and does not sell the TPUs. NVIDIA sells the GPUs, okay? People thought Amazon would build the training and would just use it for Anthropic. But later this year, they're going to be building hundreds of thousands of these chips. And if there's enough demand, then they may expand it to other customers, meaning all else equal, demand for NVIDIA's GPUs would be lower than what they would be otherwise. So this is, I think, very important that I don't think people are talking about it enough. Amazon is taking a big swing at NVIDIA with plans for a new ultra-cluster supercomputer powered by its Trainium chips. The AI supercomputer will support Anthropic, an AI startup Amazon has heavily invested in and aims to rival NVIDIA's dominance in AI model training. AWS wants to reduce AI training costs and provide an alternative to NVIDIA's expensive GPUs. Anthropic, backed by Amazon's $8 billion investment, will use this supercomputer for its AI projects. The Ultra Cluster could be one of the largest AI supercomputers in the world by 2025. AWS announced plans for the Ultra Cluster at its annual investment conference, highlighting a push to make. Let me see. So we read the. Let me see if there's any details here. Okay. Actually, I mean this whole thing is pretty good. The new supercomputer called Project Rainier is set to include hundreds of thousands of Trainium chips and promises to offer a cost-effective option for companies seeking AI infrastructure. According to AWS VP Dave Brown, it will deliver 5 times the computing power Anthropic currently uses. AWS also introduced the Ultra Server, a new server model with 64 Trainium chips designed to lower AI modeling training costs by up to 40%. So this means margin pressure for NVIDIA, okay? Now, NVIDIA has held on to the view that they're going to ramp back after Blackwell production ramp. Their margins will continue to increase to previous levels, will resume back up to previous levels. I don't think that's going to happen. This move comes as Amazon tries to shake up NVIDIA's 95% hold on the AI chip market. AWS claims that its Ultra server can drastically cut AI model training costs, with Apple's early testing showing potential savings of 50% for AI applications. The big picture is that AI chip market is booming, with projects of growth from 117.5 billion to 193.3 billion by 2027 per IDC. Amazon's entry with Trainium aims to diversify options for companies wanting alternatives to NVIDIA's high prices and supply constraints. Amazon is not severing ties with NVIDIA. AWS is also working on Project Sebia with NVIDIA, indicating a balanced strategy offering its own chips while still collaborating with the GPU leader. Amazon's AI ambitions don't stop at Anthropic. It's been expanding its in-house hardware lineup for years, starting with Graviton chips. Now, Trainium chips are the next step in reducing reliance on NVIDIA's and expanding AI capabilities. AWS is already working. See, this is the critical part right here. This is the part, okay, that people should be keeping an eye on. AWS is already working on Trainium 3 chips, promising 4x more performance than current versions when they launch in late 2025, so in a few months. All right. Next, similar article, similar topic. Anthropic hits $3 billion in annualized revenue on business demand for AI. This is May 30th article. And we're just going to read the summary. Anthropic, an AI developer, has achieved $3 billion in annualized revenue, driven primarily by business demand for AI, particularly code generation. This growth, which surpasses that many of the established SaaS companies, highlights the increasing adoption of AI in the business world. While Anthropic's consumer chatbot, Claude, has been less adoption than OpenAI ChatGPT, the company's success in the enterprise market underscores the potential of generative AI in business applications. Okay. Some revenue numbers here. It's a Reuters article. Talks about ChatGPT. Let's dig into it. This is a good article. I know we're over time, but who cares? It's a holiday. While consumers have embraced rival OpenAI's ChatGPT, a number of enterprises have limited their rollouts to experimentation despite broad board-level interest in AI. Anthropic's revenue surge, largely from selling AI models as a service to other companies, is a data point showing how business demand is growing, one of the sources said. A key driver is code generation. The San Francisco-based startup backed by Google parent Alphabet and Amazon.com is famous for AI that excels at computer programming. Products in the so-called code gen space have experienced major growth and adoption in recent months, often drawing on Anthropic's models. By the way, I was looking at some job openings by segment, by industry. Software development job openings just plunged in the last couple of years. I mean, it's really incredible. And now we're starting to see more layoffs from Microsoft and other companies as well. So AI adoption in the code gen space is extremely fast, is already having an impact on macroeconomics. Now, having said that, software development jobs are actually pretty few. It's not a large portion of the overall employment market. So we'll see what happens next. This demand is setting Anthropic apart from among SaaS software as a service vendors. Its single quarter revenue increases would count Anthropic is the fastest growing SaaS company that at least one venture capitalist has ever seen. We've looked at the IPOs of over 200 public software companies, and this growth rate has never happened, said Meritech general partner Alex Clayton, who is not an Anthropic investor and has no inside knowledge of its sales. He cautioned that these comparisons are not fully precise, since Anthropic also has consumer revenue via subscriptions to cloud. Still, by contrast, publicly traded SaaS company Snowflake took 6 quarters to go from 1 to 2 billion in such run rate revenue, Clayton said. Anthropic competitor OpenAI has projected it will end 2025 with more than $12 billion in total revenue, up from $3.7 billion last year. 3 people familiar with the matter said. This total revenue is different from an estimated annualized figure like Anthropic's. Reuters could not determine this metric for OpenAI. 2 rivals appear to be establishing their own swim lanes. While both offer enterprise and consumer products, OpenAI is shaping up to be a consumer-oriented company. While the majority of the revenue comes from subscriptions to ChatGPT, OpenAI CFO Sarah Frier told Bloomberg last year. OpenAI has not reported enterprise-specific revenue, but said in May that paying seats for its ChatGPT enterprise product have grown to 3 million from 2 million in February, and that T-Mobile and Morgan Stanley are among its enterprise customers. In the consumer race, Anthropic's Claude has seen less adoption than OpenAI. Claude's traffic, a proxy for consumer interest, was about 2% of ChatGPT's in April, according to web analytics firm SimilarWeb. Anthropic, founded in 2021 by a team that departed OpenAI over a difference in vision, closed a $3.5 billion fundraise earlier this year. That valued the company at $61 billion. OpenAI currently valued at $300 billion. Okay. We're just going to read this summary on this nonsense. Trump calls for the equivalent of 10 Fed rate cuts. President Trump criticized Fed Chair Powell, calling for a 2.5-point interest rate cut. Trump argued that the U.S. should follow Europe's lead, which has lowered rates 8 times in the past year. Powell, however, remains focused on the Fed's mandate to keep inflation low and job growth high. Okay. Interesting article on Amazon again. Orders employees to relocate to Seattle and other hubs. So I think as the employment market weakens and starts showing cracks, employers have now more leverage to end working from home. And so we're seeing this increasingly. from large companies. Amazon.com is ordering some corporate employees to move closer to their managers and teams, roiling a workforce already worried about job cuts and warnings from the top that AI will shrink their ranks in the coming years. Workers are being told to relocate to such cities as Seattle, Arlington, Virginia, and Washington, D.C., which in some cases would require them to move across the country, according to people familiar with the situation. Now, this will also have huge implications on the Texas real estate market, because a lot of these people coming from the West and let's say New York, they moved to Austin, Dallas, and some parts of Florida. And now with companies pulling back their employees to home bases, I think those real estate markets will accelerate down. They're already in pretty bad shape. Amazon is mostly rolling out the mandate in one-on-one meetings and town halls rather than sending out a mass email, said the people, who requested anonymity because they aren't authorized to discuss company plans. One of the people said the relocation policy will affect thousands of employees on several teams. Mid-career professionals with children in school and partners in established careers are reluctant to make big moves in light of Amazon's belt-tightening efforts. An Amazon spokesperson said, for more than a year now, some teams have been working to bring their teammates closer together to help them be as effective as possible. But there isn't a one-size-fits-all approach, and there hasn't been a change in our approach as a company. Amazon employees have been sharing information about the relocation mandate on the company's internal Slack channels, according to documents reviewed by Bloomberg. One employee said their manager informed the team of the need to relocate and told them they had 30 days to make a decision. Then they had 60 days to either resign or begin their relocation process, according to the person, who said they were told there would be no severance for employees who resign in lieu of relocating. The company's spokesperson said, we have from the majority of our teammates that they love the energy from being located together. And whenever someone, this is bullshit part, we're going to skip that part. When CEO Andy Jassy ordered employees to return to the office 5 days a week beginning earlier this year, there was no requirement that they move to specific offices. Amazon has satellite workplaces around the country, including major metropolitan areas like New York, Boston, Los Angeles, Dallas, and Austin, giving workers some flexibility about where they lived. Many employees were hired to fully remote positions during the pandemic. Interesting. All right. On that note, thank you very much, everybody. Enjoy your holiday, and I will chat with you all tomorrow. Take care.